I think they still need to see a bit more confirmation on the inflation picture. We had earlier this year a lot of upside surprises, which is quite concerning. We're finally, if you look at the high frequency numbers, 3-month annualized basis, finally starting to see the inflation pressures come down. Still stuck around, that above 2%, but we're still, at least we're moving away from the higher numbers.
Yeah, so they did their job. They got inflation down, but it's kind of like it went up aggressively, of course, for a whole host of supply side reasons, and it was transitionary. Oh no, it wasn't. It was other stuff as well. Funnily enough, and then it came back down, but then it just bumped about 1% higher than they felt comfortable. Is that such a dangerous thing?
It is. We've had the debate in the UK a lot around whether the inflation target should be moved, for example.
Why is it 2%? Just remind me again, Hetal, because I haven't seen a good argument yet why it's 2%.
Well, okay, so it could be 2%. It could have been set at 3% when all the central banks started to go down the independent, inflation targeting route. But we've chosen 2%, and that's really that's what matters now.
Everything's based on a figure which is. What you just said is basically arbitrary.
We could have chosen 3%, but it's about anchoring and it's about these inflation expectations. And for the last year, US inflation has pretty much gone sideways. And I think most economists, and us included, have said the last part of inflation is always harder to squeeze out. And we've seen that in action. But if we do see rate cuts, and we're expecting rate cuts this year, I think that's still about policy normalisation. We're not talking about a massive easing cycle here. Rates are not going back to where they were before.
We just heard that rates matter when it comes to the M&A market. That's one of the big drivers now for the market movement that we've seen. We heard it from Mohammed Al-Arian the other week that interest rates matter, the actual starting point, so they can calibrate for the bond market, the entire curve for interest rates. We're just not getting those signals right now. We think it's 1, maybe it's 2, maybe it's September, maybe it's later this year. We don't actually know, right? There's so many maybes, and then we get a hawkish member hitting back and saying, well, maybe we're still raising interest rates as well. When are we actually going to get the signals that tell us what the cycle looks like this time around?
I think we have to remember we've just had this period of enormous shocks, which is quite unprecedented. Whether it's after the financial crisis, we've had COVID, we've had the energy shock. It doesn't allow for policymakers to give a clear strategic direction. Their reaction function is very difficult to gauge. I think they themselves don't know. And that's why it's very, very data dependent, and you get these strange kind of communications sometimes because it's one figure or another that can really make a big difference.